You know, Danny, you and I were talking last week, and you started floating this idea that maybe QE didn't have to end. I don't know. If QE doesn't end, it seems to suggest we're in much worse shape than any of us thought we were.
Well, the Fed's made it clear that their actions are data dependent. And having been in the room on the way down, at that time we really didn't know exactly what things were going to work, how long it was going to take. It was clearly data dependent. And on the way out, the Fed's in the same position. There's no great master plan. There's no chapters in the textbooks to tell them what to do. And they really meant when they said it's data dependent. And so I think the probability, and Bullitt's probably right, the probability that they won't taper at the next meeting has risen. And probably what's actually risen is if you're going to see a positive move, it's probably more likely that the next move will be more QE rather than a rise in rates if this contagion continues.
And yet, Lincoln, here we are watching the Dow off 75 points, accelerating its losses in the final moments of trading here as we get close to the close. I just wonder, what is the danger of a taper pause?
Well, I think the danger of the taper pause is that it's off message. I mean, Jim's comments this morning, I think, caught the market a little bit off guard, thinking that, well, we're on this path. The chairwoman herself is on record as saying the actual economic benefit or value of this kind of program to the U.S. economy is negligible at best. We sit around with $2.3 trillion of excess capital on bank balance sheets, so continuing to buy assets isn't going to increase money velocity in any sort of meaningful way. Why wouldn't you end this program so that you can begin the process of reloading the gun with some bullets that you may need further down the road? And of course, the other side of that argument is that you do nothing and the markets absolutely go into meltdown mode.
I mean, are we potentially looking at a meltdown mode if the Fed does nothing?
Well,
or is this just normal pain that we should be taking?
Well, I think this is normal pain because there is a transition that has to go on here. The Fed has been out there for the last couple of weeks talking about the fact that markets have not fully anticipated eventual higher interest rates. And the question that is really being begged here is just how and under what circumstances can the Fed stop? Because it seems that every time the Fed does try to stop, you then start to see falling inflation expectations, and the price level becomes a question, and that's what triggers the nervousness in the markets.
Danny, is this disinflation, or is it potentially leading to something worse like deflation?
Well, it's disinflation. I disagree with everything the previous speaker just said. It simply illustrates that most of what we're seeing here, most of the activity we're seeing, is being propped up by the Fed. As soon as the talk is to move away, we see markets going downwards. We have contagion in the air. Yesterday, we had negative producer price data. In Europe, 24 of 28 countries have negative producer price data. We have 8 of 12 countries in Europe in deflation already, and 4 others at zero. And so this really is, it's an Ebola-like contagion, but much quicker and much more serious, if you like, and much broader based. And I think those in the markets who say the Fed should start to raise rates have not understood what happened in 1937 and not seen what happened when central bankers tightened too soon. The dangers are much greater of tightening too soon than tightening late.
Hey, look, here we are. We're dealing with at least 2.5% growth. The unemployment rate's coming down. We're adding more than 200,000 jobs a month. You know, it seems like there's a lot to be happy about in this economy. Maybe it is time we back off some of this addictive sugar.
I don't think what Danny's saying and what Kevin said are actually mutually exclusive. In fact, the case is that you have this 2% or 2.5% growth trajectory. Stopping the taper isn't tightening, actually, given the amount of actual liquidity that we have in the banking system at the moment. And we always knew that this adjustment period would be both volatile and potentially painful.
So that's what we're going through right now. We're just taking a little bit of the pain. Paul Krugman told Charlie Rose that if you want a reason to worry, just look at the bond market. Listen to this.
If you look at five-year implied inflation forecasts, they're saying that 5 more years of depression. I mean, it's certainly the idea that we're going to normalize, that interest rates are going to go up next year and everything's going to return by 2018 to the way the world was in 2007. The market doesn't believe that anymore, and neither do I.
So he basically is agreeing that, in fact, we will be looking at a zero interest rate policy for the foreseeable future. Are we ever going to be able to normalize, Kevin?
Well, and to respond to Danny, what I was trying to say is that the market is dealing with this issue of the Fed backing off, and all I'm saying is that each time that the Fed does try to back off, there's been an issue in terms of the market hiccup, and then they have to come back in. I'm not saying they should have to do it.
But why are they coming back in? I mean, they're not the market. So what if the market has a hiccup? So what if the market has a tantrum?
Well, the crux of the issue really is that if you look at what the Fed's job is, their job is to maintain inflation expectations, maintain the money supply, and in an environment where you still don't have robust borrowing, you don't have the credit system working the way it has for most of the last 40 years. So they're having to do this in lieu of the fact that we don't have robust mortgage borrowing, we don't have net borrowing expanding in the private sector, and you've got all of the fiscal authorities around the world seeming to back off from very high levels of fiscal stimulus.
Yeah.
So this is creating a little bit of disconnect in the policy message.
That said, you can understand in some ways why we're not seeing a ton of robust lending activity, and that may have something to do with the fact that rates are so low, because let's face it, it's a lot harder for a bank to make money now than when rates are rising.
Yeah, absolutely. And remember, it's 25 years, the credit bubble in the making, so perhaps this adjustment is also a larger macro adjustment to the kind of borrowing and the kind of extensive credit growth that we have seen over that time. To expect that you would be back to trendline GDP 3 or even post-recessionary kind of trend 3.5, it was always a bit of a dream, and to think that the Fed would guide us in that path any way, shape, or form was in and of itself a little bit sort of leading us down the garden path. And it turns out that, in fact, we're in a very complicated deflationary, potentially disinflationary maze.
So quickly, before I let you guys go, what do you want to own if, in fact, we're looking at a deflationary environment?
Well,
hard assets?
You want to own, for the equity portfolio, you want to own cash-rich companies as opposed to levered companies, because cash ultimately is going to do better in this environment than it has for most of the last 40 years. In other words, own companies that are going to get through whatever difficult period there is with as much flexibility as you can, and companies that have a lot of cash and a lot of cash flow. Cash-backed earnings would be a very important thing to think about right now.
And I think two other places you could look. One, where policy is actually a tailwind, so Europe and Japan, they've been explicit in terms of their trying to embark on more quantitative easing. And then places where pension funds have real targets, real return targets. So you saw MLPs and closed-end funds, high yield, bounce off of this 7% level the other day. That's a very interesting place to get back
unfortunately,
to it.
we are out of time. So good to talk to you guys. I know, Danny, you've been saying for quite some time that it would be a little too optimistic to see rates going up in 2015. It looks like Paul Krugman agrees with you, and it looks like we're getting an indication from Bullard that he agrees with you, too.